right, folks. So we are, Mickey. I'm thinking that the banks are going to do well after the FOMC. They've been kind of depressed. I think we see a lot of capital infusions probably coming in. But the trading desks are going to do really well. They're not going to do really well on their lending side because probably with this dovish monetary tone that the FOMC is going to come out with, that's not great for rates. And, that's a big part of what banks do is they lend and they collect interest. But unlike something, let's just say a Wells Fargo, where that's really what they do. They do mortgages, they do credit cards, they do different loans. They're not really a big trading entity. Not that they don't have a trading desk. I mean, every bank is going to have a trading desk. But your giants are JP Morgan and Goldman Sachs. And I think that they do really well in this environment. So that's why I'm looking at JP Morgan. Let's take a look and let's pull in what we're looking at, and we're going to go out to regular August with this. Give ourselves a little bit of time. Okay. First thing that we want to do, we know that they're past earnings. Banks come out first. We're trading 97.81. God. Come on, Mike. We're going to go out to regular August, and implied volatility for that expiration, which is the 21st, is, out of the way, magic pen, 33%. Okay, so we're going to be targeting the 105 strike. So let's look at a 100-105 strike, regular August. $100, 105. That's trading for $1.32. So the 100, 105 strike is trading. Is trading. Let's just say $1.30. So we know anywhere below 100. We're going to have two worthless options, one that we own and one that we sold. But both of them are worthless. We're going to have to pay that $1.30 no matter what. We're going to lose the $1.30. That's going to be true up to 100. Or actually 101. These are both still worthless. If we get to 101 cent, well, now we have an option that is 1 cent in the money, a worthless 105 that we sold. Now, instead of losing our 130, we lose 129. Our break even is going to be our lowest strike plus whatever we trade to get in, which is 101.30. So if we get to 101.30, that's break even. If we get to 105 or above, well, now we have a $5 option that we're in the money. We paid $1.30 to get in. We're getting just less than 3 to 1, which I like. All right. Charlie Moon agrees. Okay, any questions on that? Never understood why low interest rates would really hurt the banks that much. Because they lend money. If you lend money at 1.5%, 2%, if you can even get that, it's a lot different than, you know, the late 90s when you were, you know, doing home mortgages for 9%. If you can lend trillions of dollars at 9%, but you can't do it here. All right? But like I said, their trading desks are going to do really, really well. That's my take on it. All right, so let's see. Let me put this together. This has been a relatively short entry or video, but I just wanted to let you know why I'm thinking what I'm thinking and what the rationale behind this was, and that's it. All right, give me a second here.